And this panel is going to dive into the shifting landscape of financial markets. Please come take your seats. And they're going to look at how technology is transforming the markets. Our moderator is Tim Seymour. Tim is portfolio manager, market strategist, and frequent commentator on CNBC's Fast Money, where he offers insights on investing, market dynamics, and economic trends. And most importantly, he's a Hoya.
Thank you, Rena. First of all, thank you, Michael. Thank you, Sarah Center. Thank you, Georgetown. Thank you all for being here. This is a really exciting day, and the annual Markets and Policy event is only building momentum, not only in this community, but in the Wall Street community. And it's such an incredible group of people that Michael and Rena and David and Georgetown have gathered here today. So it's a thrill for me to be moderating. As Rena mentioned, I'm class of '88, so wonderful to have an opportunity to be back here and to speak to this group and speak in this environment. As mentioned, by day, I'm a global equity manager. I've been doing that for the last 20 years or so. By night, I gravitate over to the NASDAQ, where our host here, Tal, and his crew, we do Fast Money. And if any of you have watched this is on at 5 p.m., 5 to 6. The criticism of Fast Money is, hey, Tim, you guys are a mile wide and an inch deep. And it's like, yeah, we're a mile wide and an inch deep. That's what we're supposed to be. But we're about to go into our 19th year on Fast Money, which is incredible. And well, thank you. And thank you, NASDAQ, for being a great host to us. And as you can imagine, over the last 19 years, we've seen evolution of markets that has been extraordinary. Being also on the desk on the night when you hear, the dollar broke the buck, or that you were seeing GE Cap go down, or AIG, or these things. But then there's the real evolution of markets. And so today's panel is an extraordinary collection of market players who have been not only integral to markets functioning, but who have been innovators, who have been leading edge of technology. And what's extraordinary about this group is that we've got folks that are on the leading edge today when technology is moving at warp speed. We've had some great conversations. We're going to try to tie into some of that. But they're doing it after decades of being on the leading edge of technology and innovation for markets, where any one misstep along the way meant they were obsolete, or they were out of business, or they were the 8-track tape player, they were the Sony Betamax. These are references you kids are not kids. Sorry, you students are not gonna know. But the point is that we've got a group of really CEOs, presidents, and folks that are leaning into today's market evolution in the way they have for the last 30 years. So. Because their business cards and their resumes do it justice, I'm going to just introduce quickly the panel, and we're going to dive in because I think we've got a lot to do here in a short amount of time. But quick, Tal Cohen from NASDAQ, Lynn Fitzpatrick from CME, Billy Holt from TradeWeb, Nandini from the World Federation of Exchanges, I'm sorry, and Frank Lasella from DTCC. And by the way, I'll just say one of my stops in my career along the way was working out in Russia back in the late 90s. And I can tell you that DTC was critical to us solving and executing trades. And it's funny because we did a couple warm-up calls, and Tal, as we started to talk about just AI, he started to glaze over and he said, AI is ubiquitous to us in some sense. We're all talking about AI, everything we do. And so while there are mega trends out there, and obviously Wall Street loves mega trends, markets love mega trends, we really want to drill into the title of our panel, which is the evolution of markets and technology and how this team has played into it. And we've kind of divided into 4 different pieces. And the first piece is dovetails really the fantastic panel that preceded us on digital assets, but talking about electrification, talking about tokenization, talking about digitization of markets and what that means. And so, and again, because I'm on a show called Fast Money, I'm going to try to keep this punchy and move the ball around the horn quickly. And I want to leave room for questions, but this is a group that, it's funny because, Tal, when I think about electrification, I think NASDAQ, I think equity markets, I think CME. I think about players, infrastructure, facilitators that have been a part of it. But I'll turn it over maybe to Billy and Frank just to talk about, the equity market has been electrified for a long time. The fixed income market is really almost amazingly undergoing changes that seem to be stratospheric and somewhat novel. So Billy, jump in because I know TradeWeb, going from open outcry and the move in credit, the move in these markets in terms of the mainstream, also both not just institutional but retail, means you need electrification.
All these amazing kids at Georgetown, who are kind of trading stocks on Robinhood, almost don't quite understand what an amazing market structure the equity market is.
Yeah.
To be able to see a price and know that you're going to get executed at that price or better, wouldn't it be pretty to think that that's how the bond market has always worked, right? Yeah. The bond market is somewhere, if we were sitting here a year ago, I would say the bond market's like 10 years behind the equity market in terms of transparency, electronification, kind of all of those amazing things. The question is sort of like, where are we today? I feel like we're gaining speed very, very quickly. We were talking a little bit, I was listening a little bit, someone mentioned the great financial crisis. Again, back to the kids, like they were just almost children then. And it's amazing to think, what's transpired since then. I would say one of the most kind of underrated piece of the after effects of what happened then was really the rise of these kind of algorithmic alternative market makers, firms like Jane Street, DRW, Citadel Securities has become obviously extremely well known, who have led leading edge all the way with technology. Yep. And to see how well they've done in sort of the traditional markets, and now, as we're going to kind of talk about in this moment, kind of pivoting to tokenization and kind of where the world is headed, these firms are playing significant leadership roles with the history of winning in traditional markets into this new world. So I've seen, huge amounts of change in my kind of 25 years, in this business. But my instinct is, and I'm sure kind of everyone here feels the same way, this is the go time.
Yeah, it's warp speed.
This is the warp speed
time. And Frank, so speak about that. And actually, there's a transaction that you were involved in with TradeWeb and a bunch of other major players in the market that really kind of puts into perspective how mainstream we've come. And I think that Wall Street picked up on this, the analyst community. But effectively, we think blockchain, we think esoteric, we think these are kind of off the beaten path assets. But in fact, we were talking about moving from the chain into essentially U.S. Treasuries from a stable coin. And so talk about that. And it involves some of the biggest players on Wall Street.
That's right. So Tim, look, one of the things that's very clear is technology and the financial markets have always had this incredibly symbiotic relationship in a really, really good way. Even in the 60s and the 70s, and they were just meant for each other. And our industry has always embraced new technology, just like at DTCC, because of who we are. We will always have to embrace new technology. That doesn't mean we will use it, but we at least have to look into it, and that's what we've been doing in this point in time with blockchain. I would argue that it's even, Billy is right in that the equity markets are totally electronic, and the algos that are behind it, the trading that's behind it, are incredible. But even though the debt markets might not be as evolved in terms of electrification and technology, they are still very efficient. There is still price discovery. There is still an incredible amount of liquidity. They run really well, and particularly the Treasury market, which is really important to all of us, still operates in an incredibly efficient way. But our industry will always do that. And so what we're trying to do is, and I know we want to talk about tokenization, is it's moving very quickly now. And what I would say is, Tim, I know you want to keep this pithy, but let me
cut you off. Don't worry.
You will. Okay, good.
You're doing great.
I know you will. I watch your show. I know you could do that. Let's just go back. Quick history in time. 3 years. 3 years ago, our industry was having this raging debate about crypto, tokenization, blockchain. Where is it going and what does it mean? And the conversation went something like this. Blockchain and crypto and tokenization are going to upend the entire financial services industry. It will just turn it on its head entirely. And you had many large firms building their own L1 blockchains, building their own, what I call garden walls. And then what happened? FTX happened. Now, the truth is, FTX had nothing to do with crypto or blockchain. It was a Ponzi scheme. It was a Bernie Madoff-like Ponzi scheme, except the asset was crypto.
Yeah.
That was it, right? That was a cathartic event for the industry. Why? Because we all got sober about this. And the conversation changed because, A, we all finally started using the same words and glossary in terms, we weren't mixing up crypto with stablecoin and blockchain. We differentiated itself. And what we realized was we have an incredibly efficient financial services ecosystem built with some of the best technology that is really good. It's got an incredible risk wrapper around it and an incredible compliance and regulatory wrapper wrapped around it. But it could always be made better. And so now the conversation is how do we employ blockchain, stablecoin, and maybe someday crypto to make a really good financial services ecosystem even better? And that will be good for the financial markets and ultimately for end investors. I will argue if we get it right, it will improve price discovery.
Yeah.
And that means better price improvement for retail and institutional
Well, yeah, I
investors.
mean, look, efficiency of markets is all about price discovery, and it's all about making, I think, the investor community, and it's obviously the institutional community who demands it, but the retail investor community has become critical. Lynn, I'm curious your thought as we get into, talking about trading crypto, talking about where CME's been very active. You had a record second quarter, but some of that was really getting into TradeFi and talking about Bitcoin. And maybe somehow tie into the last panel where I thought Ross set a very interesting, provocative kind of thought of, hey, you can have collateral, which you care a lot about in terms of the underlying products you trade and your and the underlying players, but where you think some of that is going, even in the context of the business you have today versus the future. But again, cash and treasuries are not necessarily stablecoin, but they might be, and how you think about that.
Yeah, so on the crypto side of the equation, that's something we've been in since 2017. So we were fairly early in launching, and really that was customer driven. So we had a lot of institutional clients who were saying, I see a need to participate in this market, or I want to hedge my exposure in this market, but I'm maybe not as comfortable with some of the options that are out there in terms of platforms.
Right.
So being able to come to a regulated market where they know about the safety and soundness and they're comfortable with the regulatory regime, I think was really important as we launched into that space. Over time, we've certainly built out that franchise. We now have contracts across Bitcoin, Ether, XRP, and Solana. But what I would say is we always focus on coins that have an underlying market need or market utility. So, there's certainly a lot of regulatory...
There's a lot of debate about that. I mean, market utility for, I would say, most of the coins, and, I think I understand the Bitcoin utility, but I'm being somewhat facetious.
Nope, and that's fair. I think if you look at some of the excitement around crypto, sometimes it's more of a meme coin, and it's more of, a little bit of excitement, and then that goes away and it moves on to something else. When we're looking at providing hedging instruments for our clients, it really is where there's enough liquidity underlying, there's enough participation underlying that coin to really make a healthy market, because that's where you get those efficiencies.
Yeah. And let's turn to the exchanges, both Nandini and Tal, and trying to understand how you're interpreting the concept of tokenization. And once again, as you have been ahead of the curve on so many evolutions for the equity market, I'm curious, Nandini, why don't you start first and just tell us what you think is how are exchanges approaching this? And maybe, as you think also those outside of this country, we're going to have a big part of this conversation. I think we'll get into global markets, but I'm just curious how exchanges theoretically contemplate this.
Thank you, Tim. I think it's actually been fascinating to hear Frank in particular talk a little bit about the way the industry is thinking about the technology and differentiating as well. Every single market infrastructure, because we represent both exchanges and CCPs, is looking at tokenization. Not all of them will do it. We've got I'm delighted to say that, Tal is here and he can, we call what NASDAQ has done best practice, right? Mm-hmm. So I'm sure he'll be able to tell you more about it. But every single one of our members, and we have 300 odd institutions at the WFE, is thinking about tokenization. In some ways, it's an evolution of where market structure is. It's not something that the exchanges or have fought. It's rather they look at it to think, how can we bring it into an exchange-traded environment in the way that Lynn touched on, right? Because when you have a new product, investor protection is important. The best place to trade a new product is on an exchange-traded platform. Why is that? Because we're regulated, transparent, equitable, accountable, fair and transparent markets. So that's the direction of travel. I think it's really important for us to differentiate between tokenized securities and what we call mimicked tokenized securities.
Yep.
One is virtuous, the other, I think we have to make up our minds on that one.
Well, then we start to get into public versus private and RWAs and things that I think there's convergence, and we'll talk about that too. So Tal, as I think about, again, the role that NASDAQ has played, and Nandini said this, you let the markets come to you, even though you're watching it on the other side, and you're ready for it. I hear tokenization. I hear 30 trillion in tokenization by the next 3 or 4 years. I hear 100 trillion by 2030. I hear 100% of all assets will be tokenized in the near future. Is that close, and where do you see that?
Yeah. Can I start with something, which is I'm a little jealous. And a little jealous.
Okay.
Of all the
I
young
appreciate
people.
the honesty.
No, the young people here. You guys are on the precipice of tokenization, AI, all these conversations. You will have the ability to shape, influence, and modernize the markets that we're talking about here. So I wish I was 21 again, coming into markets, because you can truly
And doing it at Georgetown University.
Yeah. So I'm just inspired. The young people don't seem that excited, but you should be. You should be. All right, so let's talk about it. So NASDAQ, we think about it this way. One is the world's changing around us. Two is there are platforms that are emerging and growing around us. And three, we have this unique opportunity to modernize and advance our markets. And so what we've done here with the tokenization filing that's been referred to is very, very simple. We want to be able to shape and influence the debate around market structure to make sure that we're optimizing for issuers and investors. Issuers and investors, they're both part of the conversation here. The second thing we want to do is modernize and advance our markets in a way that preserves the market quality and the investor protections that make our markets so robust and the hallmark of the world. We have the high moral ground when it comes to our markets and the way that they operate globally. We should preserve that, embrace that. And that doesn't mean you don't embrace innovation. It means you embrace innovation, but understand what's made our markets special. And the concept of trust and integrity are really at the forefront of every decision. We think about our brand, we think about the markets that we operate, we think about all of you and coming into our markets. But the other thing that's really important is we also want to be the bridge between today's market and tomorrow's market. Let's be clear, in equities, most of the market is dematerialized already. Most of it is dematerialized. But we recognize the benefits of tokenization, whether it's mobility, liquidity, or accessibility. So we want to be the gateway that bridges that. And the reason for that is if we can help establish standards, fungibility, interoperability, then we can all reach the full promise that tokenization, the blockchain, and AI have. And it's about putting that all together. And then what we also do is, because we all think linearly in terms of the world and what the world's going to look like. You asked me if it's going to 30 trillion. I don't know, but I do know this, that if history is a lesson, we tend to, in the short run, overestimate megatrends, and in the long run, underestimate those megatrends. And so we need to basically, the pace and intensity of investment for us has to have that, where's the puck going view of the world.
This is an institution, but the Sero Center is all about not only markets, but policy. And what I hear you saying is, we have to operate, and we're going to talk about the regulatory environment and how that's stimulating innovation, how that's stifling innovation. Probably most people would say that, but let's quickly get into the global nature of what everybody here. And I think we've also narrowed this down a little bit to, there is an element of serving investors, whether they be institutional or retail, high net worth family office, and then issuers. And as I think about just the global markets, of course, when we read the newspaper and we follow stuff in DC, we feel that the globalization trend that I feel like I grew up in markets is kind of a naughty word, right? We've reversed on globalization in terms of concept, economies, openness, and I'll leave the politics of that aside. But markets are inherently global and interconnected, and technology is part of that. And Billy, I'll just ask you to talk a little bit about, I know your international business is booming. In fact, it's 40% of your business.
Yeah.
It's probably the biggest, it's the highest growth segment of your business. Where are you most excited? But what is it? And drop this into both the interplay between the global markets, the global investors, and where technology is helping you.
The reason why voice business still exists in the markets that I kind of live in, and whether or not that's government bonds or liquid mortgages, credit, global swaps, is because there's always been kind of pretty strong historical resistance to kind of transparency and all of these amazing things that we're talking about in terms of what electronification brings. Like, the more this stuff happens, no offense, Billy, at Tradeweb, like, the worse it is for me. So my brain was kind of trained very early on to kind of place bets with the people who have the most to gain from innovation and the smartest people who think around innovation, which is why I mentioned kind of early on, the concept of firms like Jane Street and Citadel and DRW. What's really been fascinating for me, from my perspective, is really we have a great global business, is how much like innovations from a micro perspective, from a micro trading protocol perspective, have really come out of Europe.
Yep.
And how quickly they have kind of gotten on board in a lot of ways to kind of where we're going around this evolution. So I'll give you just like one very kind of interesting, maybe like specific example, which is like Tradeweb kind of lives and breathes in this concept of like RFQ, right? So I'm BlackRock, I want to buy 25 million 5-year notes. I'm going to be able to go to Goldman Sachs, JP Morgan, Morgan Stanley simultaneously and get back a price in a millisecond and then trade on the best price. That sounds great, right? The challenge with that is there's a limitation around, am I giving up too much information in my search for liquidity as I ping these three amazing banks? And through Europe, they develop these protocols, we call it request for market. It's the ability for one client to go to one bank, ask for a two-sided market. If that market's within a certain bid-ask parameter, they're going to trade on one side of the market without revealing their hand. Sounds kind of interesting, sounds sort of easy, maybe sounds sort of simple. In all of that explanation, there unlocks the concept of risk trading.
Yeah.
Right? And that came really from kind of European users and their comfort zone with technology and the ability to move things forward because they have the most to gain as the markets stay more connected and technology keeps driving all of these events. So we have we're really lucky to have this amazing international business, but more importantly, I find a lot of the best innovations that come into our marketplaces actually start in that region, which is kind of a cool thing to say.
So Nandini, then talk about places around the world and exchanges where we might be surprised about that innovation and where some of the triggers have been from over here, but maybe some of that might be leading things back over here, as Billy said.
I think it's particularly, Billy's comments are particularly interesting in the context of the 24/7 debate that we're all having in its various flavors, right? So trading inherently is global, markets are global. The only question, growth for market infrastructures and markets is rarely sufficient if it's domestic. At some point, everyone needs to go internationally or abroad. The biggest markets, the biggest exchanges, market infrastructures in the world. So the question is really not so much whether you do it, but the question is really, is anyone interested in your market to do it? When we look at the WFE universe, we sometimes say that the distinction is not, are you in an emerging or developing market, but rather, are you a small exchange, a mid-sized exchange, or a large exchange? And you find exchanges in markets like Brazil, B3, or in India, the National Stock Exchange of India, Hong Kong Exchange Group. These are, Singapore, slightly smaller, but these are large markets, large exchanges, and everyone is interested in doing business in the US. Just bringing it back to this audience, who are very international, actually. So if you look at the 24/7 question, the demand is for US equities from non-US players. That's what's driving it. It's inward.
Interesting.
So going back to Tal's point about the markets in the US being the aspiration and the envy of the world.
Well, they are.
It's
They're
true.
the deepest.
Yeah.
They obviously, there's the most confidence, there's the most regulation. And by the way, I think we're going to get a little bit into that if we have some time, because I think part of the discussions we all had when we spoke over the last couple of days were that this is all in the context of being pro-regulation. In other words, markets, and think of the digital markets, and I've talked about this on CNBC, the institutional adoption is a function of the regulatory leadership. And again, we can argue whether they're actually leading or not. But I think that's an important thing. I want to quickly touch on foreign issuers, and I think Frank, you mentioned something also, and I welcome your thoughts, Tal. Where are foreign issuers in terms of some of the strategies they're deploying to get into these markets, and then how you're serving them?
I can start that one.
Yeah.
So just going back to your other question, there's the paradox of regulation and then what you're seeing in the industry, as you said before. But I will say this, just on regulation, smart regulation can be the lubricant for innovation. So smart regulation can really, really fast forward innovation, and we should think about it that way. But in terms of foreign issuers, there's a couple of things that we should think about. We operate markets in the Nordics and the Baltics. Mm-hmm. We provide technology to 140 exchanges and markets across the globe. So we're truly seeing capital formation and risk transfer all over the world, all over the world. And we have this prized, if you will, asset and exchange here in the US, the NASDAQ market, which we're really, really proud of. And we've been building that over the last 50 years in the way you said. But from a foreign issuer perspective, we're of two minds. One, if foreign issuers want to list in their home markets, that's wonderful. There are structural issues in some of these markets. We talked about Europe. If you asked me about Europe 7, 8 years ago, my answer perhaps would have been they do a really good job of exporting regulation. Now they're doing a much better job with the Savings and Investment Union in understanding the structural things that they need to change in order to be competitive. That is tax, regulation, the cultural aspect of it, the cultural aspect of wanting to support IPOs. So let me give you an example. In Sweden, we run the market in Sweden. It's an incredible market. It really is the jewel of what we think is Europe. And the reason for that is the retail base supports that market, supports the IPO market. They want to support small and medium-sized companies. The pension and asset managers invest in innovation in their country. They're nation builders in the way that they think about deploying assets and capital. And I don't know that the rest of Europe historically has been that way. So we have really tried to promote that. We've worked with the European Union. We talked to exchanges in Latin America, Southeast Asia about that. We explained to them what it means to really build, if you will, the layer and the foundation for capital formation. But in the US, the one thing that we think about deeply is 24/5. So when the US market is open 24 or 23 hours a day, or whatever it is that we're open, issuers will want to consider that as well. And they'll think about dual listings and what that means. And so I think all of these, and tokenization obviously plays into that. So I think we're going to enter a new paradigm where issuers are going to really look at their listings decisions slightly differently, one. Two, I do think because of this administration's position on America First, that's galvanized and catalyzed activity in other countries and other jurisdictions, which is good. We want healthy markets around the entire globe. Because what you find with the GFC and other crises, it always finds its weakest spot in the capital market system.
Yeah. No, and in fact, I think part of what's been interesting about the world that we live in right now in tariff turmoil, watching both dollar weakness, dollar reaction to at least policy, which I think is it's off 10% this year, but some of that may be overdone, and it gets into this whole idea of the death of U.S. exceptionalism, which I don't think we have. But I think it's a relative thing, Frank. So I want to hear also. I mean, when I think of DTCC, I think of you as providing the rails to allow all kinds of securities to settle. And where technology-wise and evolution, are you most interested here?
Yeah. So I want to try to weave together a lot of the good things that were just said because it's important. Look, to pick up on Tal's point, the world is still very balkanized. The EU is still balkanized politically, regulatorily, fiscally, and that's going to remain. Asia, it's booming, but it's still balkanized. The US still provides the deepest, best capital markets for it. Getting back to your original question about issuers. Issuers I believe you're going to see more foreign issuers, whether they're listed on an exchange or not, list in the United States, because it is the deepest markets. It allows them to get more direct to their investors that they need to engage with. And part of our job as market infrastructure, as exchanges, is to not be an impediment to those capital flows. The global markets will always be global because capital needs to be able to move freely wherever it needs to go, wherever it needs to be deployed. So our job is to make sure that we clear the path, working with the regulators and in a very strong risk framework, because we have to maintain the integrity of the markets, so that issuers and investors feel confident operating in the U.S. I'm not worried about a 10% drop in the dollar. It comes and goes. I just think we need to execute on what we have.
One of the great things about our currency is it floats.
Exactly. And that's why China
we may be
is
printing money against it. We may not. That's a different issue. But I agree.
And so this is why embracing new technology like tokenization is imperative. We still have to work through a lot, but just think about it. The U.S. capital markets altogether is about $130 trillion. $30 trillion is U.S. debt. The other $100 trillion is in corporates and in bonds, right? We've got those at DTC.
How much time, by the way, I'm sorry to cut you, how much time do we have? Because I want to be sensitive to getting student questions and whatnot. I think, does anybody, I think we have 10, 12, 15, okay.
I'll finish up quickly. If we are able to tokenize those real world assets, maintain that asset class that it is, not change it, we can then begin to move securities for collateral that we talked, Billy touched on it earlier, much more efficiently. Just think about this one. Right now, Sunday night in the United States, we're closed. There is a need for dollar liquidity in Asia on Monday morning when they open up. There's no collateral to move to get those dollars there now. You're able to move securities on a rail and move it instantaneously by moving cash and securities, so it's totally collateralized, and give those dollars into Asia right away. That is huge. Sure. It's a game changer. Yeah. And that will help. That's just one example. I can give you 10 on how it continues to make the U.S. competitive, makes the capital markets, the safe haven, and helps capital markets move in a more efficient way.
Billy, what do you want to add to that?
Just very quickly, my eyes kind of like picking up that spotlight up there. There are always markets that operate in the bright lights, and then there are markets that kind of operate a little bit more in the shadows or darkness. There's not a better example of a market that used to operate in the darkness than the global swaps market. Okay, and everyone understands the Lehman collapse and the after effects of that market living in darkness. Regulation, and I was a pretty big part of this, which had its big kind of twists and turns around this, but the creation of CEFs really moved that market from a dark market into a bright lights market. Completely changed the foundation of clearing and transparency from my perspective of really the most important market in the macro world.
Sure.
Once you've learned that lesson, it's impossible to kind of unlearn it. And when we just think about the general kind of inclination of where the regulatory regime is going around the world that Frank's describing, it's impossible to not feel excited about this next wave.
So, Lynn, I mean, you're in the middle of some of these, not only global markets. I want to hear about what you're seeing from global institutions and some of the flow. And again, we're talking about a world where maybe, first of all, the global markets, we have global institutions that are investors in our markets, but your products are global by nature. And any trends to talk about here? And again, because the regulatory environment is something that it's all about that. That's the structure you operate in. Are there places that you are seeing more flow from because of that?
Yeah, I think the area I would point out is more on the retail side.
Yep.
So if you think about some of the comments we've made earlier about technology, the access that the retail user has today to information is so much different than it was a decade ago, even 5 years ago. So the ability for that retail participant to have that same information flow as the institutions used to have has really changed the dynamics. So what's important for us as we think about that opportunity and that set of users, we're really trying to meet them where they are.
Yep.
So things like our micro suite of products, which are smaller size futures and options, are part of it, but those are still larger size than kind of a mass retail opportunity. So doing things, we announced recently a partnership with FanDuel, where we're really trying to meet that user where they are. So the way they like to trade, the size they like to trade, small as $1 notional. You Can't lose more than you put
Is
in.
there not, because when I hear that and I think about historically, again, how I've thought about commodity and futures markets, is that by definition they had to be institutional in terms of their size. Has that changed?
I think it has. I think it's that information flow, and also people are more interested in being self-directed. So these retail users of today might become that institutional trader tomorrow, but they have to start getting kind of that trading experience, get that exposure to the markets, and we think some of these newer ways, like event contracts, are ways that they can get that education and continue along that journey.
So I don't know if there are student questions, and if you want to line up at the microphones, great. We'll try to call on you, and we're going to keep going, but we'll wait for you to line up. Let's shift gears a little bit and talk about kind of this convergence of private and public markets. And some of this is being driven, especially by private credit, is, we could spend a day on private credit in terms of the size of this market, the impact of this market, how it's impacting funding, how it's impacting also where retail investors are suddenly involved in private credit they may or may not know anything about. Who wants to tackle this one, convergence of public-private? Obviously, from an exchange perspective, you have a view, and you have a view that there's a place for each, and in fact, strong private markets are obviously great for public markets, and that's been your approach. Any thoughts on this? Because you're seeing companies that are staying private longer, and they, that NASDAQ listing, which is always a champagne moment, maybe they're waiting longer.
Yeah, and so I see there's a question there, so I'll be quick here, which is the private markets have grown for a few reasons. One is companies are staying private longer. You have a lot of unicorns that are private, and we have a very vibrant and robust private equity venture capital community, and that's really good. I think that's really healthy, and again, one of the things that makes us different. From a private-public perspective, we see them as complementing each other, and we provide tools to both. From a public perspective, I'm just going to take it from that perspective, is we need to make adjustments to the public markets because capital flows where it's most welcome. And in the public markets, we talk to issuers all the time. There are issues around proxy reform, tort reform, disclosure reform. We saw President Trump put something out just about a week ago or 2 weeks ago talking about earnings release. While we're going to have to talk through that, there's a lot of nuance to that topic. We're really pleased that capital formation is at the front of the docket. It should be, it needs to be. We need healthy markets because public markets are still the #1 generators of job and wealth creation for all of you. And so private markets, we will serve them. They're important. We need to get the balance right on the disclosure side because not every company is OpenAI or SpaceX,
that's
right?
And also from the companies themselves. I mean, that's dialogue that's going on right now, obviously, right? Accounting principles, what should be involved there. Tal, thank you. So first student, I see you kind of in the shadows. Please go ahead, and it's nice because you can now either direct your question to a particular panelist to get me off the hook, to keep this great team, keep everybody in the game. Please go ahead.
Thank you guys so much for coming today. Billy, you mentioned like new firms driving market innovation like Jane Street and Citadel and DRW. Well, at the same time, Frank, you mentioned like the need to preserve market integrity, and then that's like against the backdrop, I guess, Lynn, kind of putting everything together with the rise in like retail traders, especially in the options markets. So my question is more like a couple of months ago, we saw like the alleged market manipulation of Jane Street and the Indian markets. And my question is kind of like, do you feel a need to kind of like protect retail investors from like the bigger, more innovative like institutions that are like developing new strategies? Is that like a priority?
It's an amazingly good question.
Yeah, no, you should be in my team.
Amazingly good. It's a complex question. So much kind of machine learning and AI that is kind of predicting behavior after there becomes versions, I'm going to say this very carefully, well, there are sort of best-in-class execution. In a lot of ways, that's an easier thing to do when markets are anonymous. When it's a disclosed market and kind of a firm knows who's on the other side of that trade, the kind of the after effect of the market is a different kind of thing. You're asking a very kind of nuanced and really interesting question. We're seeing, firms like Jane Street and Citadel and DRW kind of entering into fixed income in big, kind of bold ways. I think operating marketplaces that are reliable and that have the kind of integrity that we've been kind of talking about is the whole ball game. and really how you operate a marketplace around the very kind of complex topic of data and who you give your data to and how you share data is really everything. I kind of say, look, we have a good business where we monetize our data, but never at the expense of the integrity of our day job, which is running a marketplace. But all of this stuff is going to continue to play out. If I was kind of talking to these students, to you guys like a year ago, I'm pretty sure like everyone would know who Jane Street was. Now you guys definitely do. I mean, like their trading results are just absolutely incredible. So the evolution of these firms in our world is a one-way.
No, they've look, after GFC, we had a liquidity vacuum that needed to be filled. Tal.
I just want to add something. So we have a surveillance solution that we provide that looks after market abuse. The number one question we get from the users of our platform is, can we use AI, I want to bring AI into the conversation, to calibrate our alerts to find market abuse across different asset classes in real time. So look at historic patterns, use Gen AI, help us calibrate our alerts. Used to be manual and iterative, and now we save them all that work so they don't have to look at all the false positives and they can focus on the real market abuse. And if you do that, that enhances the integrity of the market, which means you get more adoption. So if you think about it, just across asset classes with 24/5 and tokenization, how important is AI going to be to the integrity of our markets?
Awesome. By the way, we've got 3 minutes left, and I see 9 questions. No, we want to get these questions, and we're going to get you answers back. So part of what we should be doing to follow up with you is let's get these questions, get them to the team here at the Sarah Center, because we'll get back to you. I'm sure they're great questions. Over here, go ahead.
Hi, thanks again for coming to speak with us. We really appreciate it. My question is, there's a lot of young adults in this room looking to get involved and understand these ever-developing markets. And so what stress scenarios like cyber risk or regulatory fragmentation do you see posing the most risk to bridging the gap between today's market and tomorrow's market? This is for any of the panelists.
Who wants it?
I can take it.
Nandini.
I'd say that it's a great question. I think cyber risk we have always had. And I think if you say at any given moment, if you said what keeps you awake at night to any of my peers around the table here, they'd say it's cyber risk. I think regulatory fragmentation or market fragmentation, as we call it, is really the number one friction that we see impeding the smooth flow of capital across markets, across our universe. Yeah. So we can't retire one at the expense of other, but with cyber you can manage, with diligence and with, good technology and with a certain amount of fear. And then the second, market fragmentation, we all have to work towards, especially the regulatory community. Did you want to say
one thing
something?
I'd say is like, guys, it's like we've gotten so much more sophisticated around technology. Like, be likable. And I really mean that. Like, institutions still like to do business with institutions that they like and respect.
Great point.
There's still a
so
human,
it's not a faceless robot. There's an institutional relationship, and Wall Street and finance functions like that. One question.
Hi, thank you guys for being here. My question is, with evolving markets and technology reshaping finance, how would you personally stay ahead of the curve, and what advice would you give to students to implement that into their career?
Lynn.
I think being interested. I don't think there's any of us here that know everything about the new technologies that are coming, but we certainly are trying to stay as close to it as we can, but things are changing minute by minute. So I think it's really being curious, really reaching out to experts in their field, taking in all that information and trying to synthesize it, because there's no one answer out there, and it's going to continue to change on a daily basis.
I just got the red light that said our time is up, and I promised to run a tight ship, so I want to give it up for a great panel. Tal, Lynn, Billy, Nandini, Frank, thank you.